firm, but I also work in the startup and emerging growth field with Carissa and Megan, who are going to be presenting today. So I'd like to introduce Carissa Habsburg, and she's going to do the presentation, do it right the first time, and then Megan Rechenberg will join in at some point of the presentation, and she'll talk to you about, I think it's payroll taxes and some other exciting matters. Oh, yeah. So with that, I'll give you Carissa.
Hi everyone. So I'm going to talk, like as Steve said, just about some of the major basics that you guys need to know. As a startup, you guys are Jacks and Janes of all trades. And the end result of that is that there's just so much that you have to do and you don't know what you don't know. The title of our presentation is Do It Right the First Time, because there's just a lot of things that if you don't focus on or don't even think to focus on early on, it costs a whole lot more to fix it down the road. So if you get some good advice and people surrounding you, a good advisory board, your team, making sure to have those people in place, I'm sure as you well know, it sounds oxymoronic, but that's so, so important. So I'm just gonna dive right in and ask a couple questions. Does anyone have an entity? If you do have an entity, can you tell me what type of entity you have?
I have an LLC.
You have an LLC? Okay.
An LLC.
You have another LLC?
Also an LLC.
LLC. Love it.
A B Corp.
B. All right. We're going to put that one down here, similar to the C.
LLC.
You have an LLC? Anyone else? All right. You have an LLC? All right. No C Corps and no S Corps. Why did you guys choose LLC? Do you know?
My accountant told me to do that.
Wow. That's usually the answer, and I actually hear that quite often, but the question of why behind it is so important to you guys personally, and then as you grow, because if you're looking for investors, that's something that they'll ask about. How about you? Do you know why you chose B Corp?
Well, I'll say a little bit about the startup. The startup is a booking platform for services that is going to be member-owned.
Okay.
So a benefit corporation seemed to be the
way
to balance
public.
out the mission plus the revenue generated.
Some of the topics that we're talking about at the formation might not necessarily apply for you because your funding and what you're doing is a little bit different, but the concepts behind some of our slides will still be the same. Okay. LLC. Anyone else why you chose LLC?
We were told that if we go with LLC, we can avoid a double tax at this moment. And then later when we start to raise funding, and VC usually asks you to transfer form to a C Corp one.
Correct.
And we plan to do that when we get there to that stage.
Exactly. You hit the nail on the head there. I'll talk about both of those points. Did you have another reason why you chose LLC?
I needed a pass-through entity for investment.
Pass-through entity for investment. Do you have other investors? Or is it just your personal investment?
It's split.
It's split 50-50. Okay. So all of those are really good answers, most particularly the question of being an LLC you can convert later. Big picture, what is an LLC? An LLC is a pass-through entity, and a pass-through entity means that the entity itself is not taxed, but rather the income and loss gets pushed out to its owners. And then it's taxed on your personal tax return, okay? The good part about LLCs is if you have profit, it's taxed only at the individual level. And that eliminates that double taxation. And I wrote a little example up here of a C corporation, just so I'm going to walk through it just to give you the big picture of what it means. But let's say you have $100,000 worth of profit. The top C corp rate right now is 21%. So let's say it's flat rate of 21%, which leaves you with $79,000 after your profit. Then, in order to get those profits out to its owners via a dividend distribution, you're taxed the second time. It's called a capital gain. And that capital gain rate, the top capital gain rate, is 20%. Okay? So that double layer of taxation, that's what they're talking about. So you've just now paid 41 cents on the dollar in order to, or more than 41 cents, about 36 cents or so. But you just paid 41, the sum of this, like 36, I can't add on the fly, $36,000 in taxation. Whereas if you were a pass-through entity, it would be taxed at your personal rate, which doesn't always tend to be that high at 35 or so %. So far, so good? Another reason why some people decide to file as a partnership, and this is a little bit of a misnomer, and I'm skipping around on the slide, so this is something that's important, but if you have profit of $100,000, and you have 2 owners, 50-50 owners, how does that profit get split out? Anyone? I'm not trying to trick your economists.
50-50?
Yes. So you got 50,000 and then another 50,000. Okay? Let's say that profit was a loss. How does that profit or that loss get split out? And let's say, let me give you a little bit more facts of this. Let's say CMU is one of the owners and they're the ones that's funding the loss. Let's say this is CMU. Okay, and they gave you $100,000 of equity, or debt, as the case may be. Sometimes they'll give you convertible notes. How is that loss split? What do you think?
50-50?
Nope, that was a trick question.
Yeah.
So this is something that we see done a lot incorrectly, because you would assume that as an owner, you're a 50-50 owner, you would get to have that profit 50-50. That's correct. But losses don't always work the same way. Losses, based on the tax law, basically go to who economically paid for that loss, okay? And so in this situation, all $100,000 would go to CMU, okay? Where does this matter? Why do you care? Well, I'm glad you asked. Let's say you just took that $50,000 loss and you used it to offset your spouse's W-2 wages, which happens. I see that happen sometimes. What you've just done is you've underreported your income and you're subject to interest and penalties for the underpayment of taxes. This is a very important concept that pass-through entities need to identify and understand, because you might not always get those losses that you think you're entitled to. Okay? So the second thing is LLCs are easy to convert. You can legally stay as an LLC. That will save you so much money. Keep that in mind. If you do decide to convert, you can legally stay as an LLC and do a check the box election and just convert for tax purposes. Investors tend to not want to wait until your entity's tax return is done in order to get the K-1, which shows their share of the profit or loss. So because the K-1 is dependent on the completion of your return, let's say an investor is invested in 50 other partnerships. It's a crazy time for them to have to wait for all of your K-1s. C corporations are a whole lot easier because the entity is taxed in and of itself. So far, so good? At the end, you will probably consider converting to a C corp if you are looking for institutional investors, and that's okay, all right? One additional thing I'll mention, if you are an LLC for a period of time and you've lost money, which are startups, that's what you do, and that's okay. And you've taken these losses in the past, perhaps you've been able to take some of these losses, you should consult your tax advisor when and if you convert, because there may be some tax effect whenever you do convert. I'm not going to go too far into the detail because that's a lot more than what the scope of this conversation is about. But it's just something to think about when you do decide to convert, if and when that happens. Okay? Having fun yet? Okay. One other reason to consider a C corporation is there's a code section, and I'm only going to say 2 code sections during this discussion. And if you remember anything from this discussion, this is something that's so incredibly important. Code section 1202. Okay? Code section 1202 basically says if you're a C corp and you hold your stock for 5 years, not 4 years and 11 months, but 5 years, and you sell your stock, not your assets, but you sell your stock, you could exclude up to $10 million from federal capital gain per individual. Let me give you an example. Let's say you sell your company for $40 million and you have 25, 25, 25, 25% ownership. Everyone owns a fourth. So therefore, you're each entitled to $10 million. out of the $40 million sales price. You can exclude, if you're an individual, let's say there's 2 individuals, CMU owns one of them and a VC firm owns the other piece. The 2 individuals get to exclude $10 million a piece, that's $20 million. CMUs are not for profit, so they don't care. And then the VC, depending upon the type of entity that they are, may benefit from it. This is something that you need to address when and if you do intend to exit, because there's planning associated with it. If you can delay it 1 month, that 5-year mark could be hit. And then secondly, making sure to pay attention to the type of sale that it is. That it's an asset sale versus a stock sale. Buyers would prefer to buy the assets of a company, create their own company, and put it in that new entity. Why? They don't want to inherit your skeletons in the closet. They don't know what's coming down the pipeline. So the creation of their own entity means that they can also write off their investment, their purchase price, sooner than buying the C Corp or buying the stock. I see stock deals happen every day. Many of our clients have taken advantage of this provision, so it happens, especially in your startup world. This happens a lot. But it's something to think about as you continue to grow and what your trajectory is. You might consider executing your options if you have an option pool sooner, because it'll start the clock on those options. So there's just some timing associated with it, but 1202 is a home run. It can seriously mean so much to you guys as you grow. And I've seen a lot of tax savings go on with it. So this double taxation piece is irrelevant when it comes to something like that, especially at the early stages because you're not making any money. So far, so good? Okay. The last thing that's on this slide is the second code section that I'm going to reference, 83B. Does anyone know what 83B is if you've created your entity yet? Has anyone filed 83B elections? Are any of your shares restricted? In other words, is there a vesting schedule associated with them? No. Okay. So when you give investor money, they tend to require your ownership to potentially vest. You might have to give the shares back and then reissue them. Why do they do that? They want you to stick around. They don't want you to take their money and run. So if they're going to invest a couple $100,000, they want you to stick around. So Alpha Lab, Innovation Works, for example, they often require some vesting associated with it, and I see that often. If you have a situation where you're required to have your shares vest, or units, this works the same for LLCs or C corporations. But if you have a situation where your shares vest, you can make what's called an 83B election. An 83B election tells the IRS that you're electing to pay tax now on the value of those shares, I'm just going to say shares instead of units, on the value of your shares right now rather than as they vest. So let's say, for example, you get $100,000 shares in year 1, year 2, and year 3. Okay? I'm going to do an exaggerated example, but bear with me because this will get the point across. Year 1, the value is 0. Sorry guys, you got $1 million idea, but no one's paying for it yet. That's how it works. Let's say in year 2, it jumps to $1 million. Okay? And then in year 3, it jumps to $5 million. You guys got an awesome idea. You're rocking it. Way to go. An 83B election says, I'm electing to pay tax now when the value is 0 rather than as they vest. What does that do for you? Well, the IRS says that when you get something of value and that value is $1 million, you have to pay tax on that even though you don't have the cash to pay for it, even though you've not sold it, even though you haven't had a situation where you've had the ability to pay for it. You just now have to pick up $1 million in ordinary income without the cash to pay for it. So far, so good? Yes?
What's the $100,000?
The $100,000 is the number of shares you're getting in 3 tranches. Year 1, you get $100,000. Year 2, you get the second $100,000. And year 3, you get the third $100,000. So just it's an example of vesting where you get them over a period of time. So in year 2, you've just paid tax on $1 million at ordinary rates. Let's say in year 3, the value is $5 million, but you sell your shares, okay? Actually, I'm gonna make it, let's say it's, and then you sell your shares at $5 million, okay? Because you just made bank and you rocked it, way to go you guys. Well, now you have the cash to pay for it, but at each vesting tranche, if you didn't sell your shares and you had value, you had ordinary income to pick up. Ordinary tax rates are higher than capital gains tax rates. The highest ordinary rate right now is 35%. The highest, 37. The highest ordinary rate for individuals is 37%. The highest capital gains rate is 20%. Okay? So the next step is if you were to sell your stock at $5 million and you've paid tax already on the $1 million, you have federal capital gain of $40 million or $4 million. Okay? If you would have made the 83B election, you would have capital gain on the full $5 million. So essentially, you are being taxed at a lower rate by making this 83B election, and you are not having to come out of pocket every time these shares vest when you don't have the cash to pay for it. Does that make sense, guys? Any questions associated with it? At the end of the day, what I want you to get out of this is the 83B election is a no-brainer. The value of your shares early on is 0. Make the 83B election. The caveat is as soon as you get these restricted shares, you have to mail the 83B election to the IRS within 30 days. It's very time sensitive. You have 30 days. If you're working with an attorney who works with startups, they will know to help you out with this. The second thing is a signed copy needs attached to your entity's tax return. So because a signed copy needs attached to your tax return, I recommend just making sure you keep a signed copy of it. You don't know how many times I don't see the signed copy kept for your records. Okay? That's the 83B election, and that's the first step. Yes?
So that's specific to granted units as opposed to options?
That's correct. This does not apply to options that vest over a period of time. Granted units that that you actually own, that's where this applies, if there's a vesting schedule.
And so if you pay taxes up front on stock, which still needs to vest, but then you actually leave a company before they vest, but you've already paid taxes on those stocks, then how does that?
Usually the fair market value is 0.00001. There's like a bunch of zeros in front of that one. Depending upon the number of shares you get, the highest number I usually see is like $10. So you've either paid $10 for your shares, if you actually pay for them, like the 83B election says, or if you don't pay for them, you've just included $10 in your income, and that's not going to make your life difficult.
Right, but if you're not necessarily doing this at the outset of a company, if you're...
Then yes. If you decide to leave the company, any of those vested shares could be yours and you keep those, but any cost that you've put in up front would be considered a write-off, capital loss in other words. So you would be able to take some benefit to the tax that you paid because that becomes your cost basis. Just like any other stock, if you have a cost, any proceeds would offset that cost. It's a good question. I have seen that happen, 83B elections be made at a later date before, like after the inception, and that's usually when your intention and you think that the company is going to be bullish, that the value is going to increase from there. And the intent obviously is to stick around, but yes, you're right. Very good question. Anything else? Okay. Having fun yet, guys? The next slide relates to state income tax. So what I've been talking about right now is more from a federal standpoint than a state income tax standpoint. At the early stages, you guys are operating probably in whatever your home state is, whether that's Pennsylvania, West Virginia, wherever it ends up being. And more often than not, you have to file a tax return in that state. Makes sense, right? You're operating in that state. That's where your place of business is. So you have a tax return due in that state. But as you grow, there's different types of revenue streams. So is everyone in here a software as a service company? Does anyone have any widgets or components, physical components to what they're potentially going to sell? You guys might? Okay. Is there a software as a service component to what you're selling? Or is it just straight widgets for you guys?
It's both.
Straight widgets?
No, with the software.
It's a combination? Okay. How about you?
Similar medical device.
Medical device? Okay. So I'm going to take both of them in turn, if you don't mind. Software as a service is something that's happening more commonly in the startup world, which makes sense because we're technologically inclined, all of us, especially you guys at CMU. But what happens is many of these states want a piece of the pie. And how do they get the piece of the pie? They get a piece of the pie by saying, if you have a customer in my state, and you're a software as a service, so one of your customers is using that software in my state, you have to source revenue to my state. What does that mean? Well, whenever you pay tax on profit, some of that revenue that generated that profit needs to be allocated to that state, and therefore you may have an income tax filing in that state. Because many states are they're taking on the role of, if you have customers in my state, you have income in my state. You have to pay tax in my state. Not all states do that for software as a service companies. Some states say that you have to be physically in my state to source revenue to my state. That's becoming fewer and far between because many states are jumping on board with this just because our world is so virtual at this point. So when you're in a loss situation, this is less of a concern because what are you going to do? Allocate a loss to the state? What do they care? Like, you're getting a loss. Some states have minimum franchise taxes that you would have to pay attention to. California, for example, is probably one of the most aggressive states in our country because they have an $800 minimum franchise tax that whether or not you source income to their state, if you have an employee in their state that you're paying over, I think it's $55,200, or at least that's the number last year. Don't judge me, guys, for memorizing that. You have a filing requirement if you have an employee in that state, even though you had no revenue source to that state and now you pay $800 for whatever reason, because California wants a piece of the pie. What do you care? What do you have to know about right now? Get a process in place before you're revenue generating to be able to track revenue by customer. Early on, you might say, I only have 10 customers, so that's not difficult. But sometimes applications, you might find you get a lot of revenue really fast. Google Analytics and a lot of those other platforms out there help you track that kind of thing. But it's something that you don't want to be catching up on at the end. Yes?
In terms of tracking, so one of the important things that I'm looking at now is setting up some of these systems in place.
Yes.
For example, like I have a system for all of my sales reps so that I can track kind of the activity and the number of calls and revenue. Would you recommend having something set up like with QuickBooks or an Excel, or kind of how can we set up so that when we start generating revenue from states outside of Pennsylvania, for example, Ohio would be one of my first foreign states. For all of my customers in Ohio, what do you recommend as a system for me to track that, or to have my accountant come and look at that once that is generated?
I see if you're planning on using QuickBooks, I see the generation of vendor reports being helpful. Vendor reports, you can identify what the total revenue is by vendor, and there's usually an address if you're putting that field into QuickBooks. There's other platforms out there. Excel is, I think, a little bit more rudimentary. You can use QuickBooks and then kick it out to Excel and do sum if formulas. I've seen that happen as well. It depends on what platform you're using and the type of service revenue that you're generating. Sometimes it's easy to source it where you're billing the customer. Other times it's not easy to identify where the customer is really receiving the benefit. Sometimes, let's say it's going to Procter & Gamble, and then Procter & Gamble is sending your product or service out and doing all of that. It's a case-by-case analysis to say like what the best method is, but we can talk after this if you have any specific questions.
Yeah,
is that
would be
okay?
really helpful.
Yeah, because I see various methods of doing it. It just depends. Okay. From a product standpoint, products don't have as much issue from where the customer is receiving the benefit. It's a little bit more on the software as a service side. But there is still some exposure, especially if you guys are implementing the actual widget in a particular location. The medical device, let's say you need to be there for a 2-week period. Some states have like a threshold to say if you're in my state 2 weeks, you now have a filing exposure in my state. Not every state is the same though, but there is movement to try to get everyone all on the same fact pattern. Some states say it doesn't matter 3 days, some states say 1 day. It doesn't make a difference. At the end, what I'm trying to get a point across is have a system in place, okay?
Thank you.
Okay. If you guys go to trade shows, you sometimes are required to register with the state in order to go to those trade shows. Be worried, be cautious of that, because if you register with the state to do business, you're now on their radar and they will probably expect an income tax return as well. Okay? Not to mention sales tax, which we'll get to in a few moments. Right now, you guys just need to get a system in place. Why does this matter? This comes out in due diligence. If you guys have an investor who's looking to come in and invest X amount of dollars, they will be asking these questions about your state tax compliance. If you guys are looking to be acquired, I've seen many a due diligence list, and we've helped our clients through that. There's a massive section on state tax compliance. This is just something that you don't want to forget to focus on. Okay? Lastly, the last thing on this slide is if you have an employee in another state, generally you have an income tax filing in the other state. That's not the general rule for every state. Like I gave the California example, it was like $55,000 X. If you have like an employee below that, then you're probably safe, but just think about it as you go through, okay? And that number changes with inflation every year. That's all I have for state income taxes. Questions, concerns, complaints?
I have a quick question on,
yes.
So with SaaS, it's very common that you have like a monthly subscription, right? So
yep.
You'll have a total, I'll just use round numbers. Let's say it's $10 a month, so $120 a year.
Yes.
If I charge my customer, let's say I do a 2-year, where I say, hey, we'll lock you in for 2 years, so it's $240. With this tax situation, is there any way that they look at like future earnings? So like, let's say I'm charging for 2 years, obviously those taxes could, if they were month to month, they would be over a 2-year period. Mm-hmm. In that case, if I sold a $240 package for 2 years, would I split up 2019, 2020, and then 120 and 120? Or would I say, hey, I earned 240 in year 1?
It depends on your method of accounting. There's 2 methods of accounting, cash basis and accrual.
Okay. From
your accounting classes, anyone remember what that is?
Mm-hmm.
Big picture, cash basis. Cash comes in the door, you pick up income when cash comes in. So if you got paid 2 years worth up front and you're on a cash basis, you have to pick up that income. Mm-hmm. If you're on an accrual basis, the thought process behind that is you pick up income as it's earned. So the $10 would be split out over the over the 24 months. Mm-hmm. So to answer your question, it depends on your method of accounting. And there's actually an election on your tax return. You have to check a box to identify what type of accounting you are. That's something that, it's a very good question. Whenever you go to file your initial tax return, it's something you will have to think about. You have to think about what your revenue method is going to be. Do you plan on getting money up front, or do you plan on getting money over a period of time? If you plan on getting money up front and you're not under an accrual method, you might have to pick up income without the offsetting expenses sooner than you might think. Okay, so it's a topic that you should talk about with your accountant.
That's what I was going to ask too. Is that
yes,
more of a personal?
Without a doubt. It depends on your facts and circumstances. I have some clients on a cash basis versus an accrual basis. I will tell you from a management perspective, you guys as entrepreneurs are going to want to have it on an accrual basis, because that's how you personally will be able to better manage your company. Because if you get cash influx at the beginning of the year, but you don't know who you owe money to, that's not always a good method of tracking what you're doing from a business perspective. Okay? Okay. Sales and use tax, I'm not going to spend too much time on this slide, but if anyone knows Wayfair, Wayfair is that online retailer for furniture. Wayfair recently lost a case with South Dakota where Wayfair was trying to make a case that they didn't have to pay sales tax on South Dakota customers. South Dakota had no physical presence in South Dakota. They had no employees in South Dakota. They may have had employees, but that doesn't matter. They had nothing going on in South Dakota to say that they should have picked up and paid sales tax on their sales. Wayfair said that we didn't have to pay tax. South Dakota said that you did because the customer receiving the goods were in my state. Wayfair lost, unfortunately. And what's happened is there's a new threshold that's being put in place across the country. It's not the same for everyone, but if you're selling a physical product into another state and you have more than 200 transactions or $100,000 of revenue in that state, that's not the threshold for everybody, but that's a general. It's usually not dipping below that for fear of it becoming unconstitutional. That's 200 transactions and $100,000 of revenue combined with your customers in a particular state. You may have a sales tax filing requirement. Now, whether or not you're required to collect and remit sales tax is something each of you individually would have to address. You may have no requirement to collect and remit, but if you cross those thresholds, you might have to file a zero balance sales tax report. It sounds like it's stupid, it's bogus, but basically the states want you to be on their radar from that compliance standpoint. So that's another reason to have a method of tracking where your sales are. Software as a service company, right now there's about 15 states that tax software as a service. Okay. It's just a facts and circumstance situation. I just recommend you have at least an idea as your sales grow. What we do with our clients is we assess it either on a semi-annual or an annual basis. I ask for a breakout of revenue, and I say, okay, well, you have so many sales in a particular state. Do you want to consider filing? And they may consider doing that in the future. But it's basically knowing where your risk is. If someone comes in and doing their due diligence from an investor standpoint or an acquirer standpoint, they will ask those questions. If you have a logical reason why you did what you did, that's the important piece. Okay?
Is there any type of concerns or considerations for charging a sales tax? Like, you know, I was kind of taught, like my dad just said, hey, just generally when I was selling websites, he was like, you know, just add a 7% sales tax or whatever. And that was the state that we were operating in. Is there any type of risks or any concerns of just starting out with, you know, let's say charging a 7% sales tax, marketing the sale price, you know, $100 or $120 a year, and every customer is charged, hey, a 7% sales tax will be applied, and then using that? Or do you have to apply that sales tax only in states that require you to? Like, is there anything that you can get in trouble with? Are there any concerns about that? Or?
A couple, yes. If you decide to collect and remit sales tax as an officer, you are on the hook to pay those sales tax to whichever government you've collected it from. So if you've collected and remitted that sales tax, you need to, if you've collected that sales tax, you need to remit it via these sales tax reports. Another reason why you might consider not doing that is you have to have a sales tax license number. And if you really truly aren't required to collect and remit sales tax, you having that sales tax number now requires you to file reports whether or not you collect and remit sales tax. So you'll be required to file zero balance reports. Another reason to be cautious about that is if you are on their radar for sales tax, you are now on their radar for income tax. So you may have an income tax filing in a state that you might not have otherwise because you weren't on their radar yet. Pennsylvania has a form called the REV 717. Take a look at that. That'll tell you if you have a collection requirement, at least in Pennsylvania. For other states, it's a case-by-case basis. Usually it's a cost-benefit analysis that the owner will do. If you don't have a lot of sales in the state and they're below certain thresholds, you might not take the steps to sign up. If you want to be 150% compliant, then perhaps, but it's a case-by-case basis, and I would just suggest at least having that method in place and addressing it on a state-by-state basis because not every state is the same. Okay, does that answer your question?
Yeah, so what you said is that maybe instead of just doing a blanket application of a sales tax, spend a little bit extra time to go and do the due diligence on which states you need to, because you can become kind of on the radar. If you're just collecting sales tax just blanketly,
right. Yep.
You could be hit in each state that you have that on there.
That's correct.
Okay, thank you.
Okay. Use tax, the last thing I have on here is use tax is the flip side of this. If you pay for something that you know you should be paying sales tax on, Pennsylvania often, for example, will issue a notice or a questionnaire saying, did you pay for a computer that you didn't pay sales tax on? If you say yes, they'll say you have to owe sales tax. And there's a form on there's a part on your personal tax return that asks about that. I'm not going to spend too much time on that right now though. If you have questions, let me know. All right, that's all I have for sales and use tax. Megan?
She always makes me talk about the fun one, which is payroll tax. That is everybody's least favorite topic. So I guess payroll tax is an area that we always see a lot of issues with, and it's for good reason. If you don't know how to do payroll, you shouldn't do it. So I think all of you are LLCs. So basically with a C Corp, it's kind of like, you know, you get a W-2 and you're an employee, whether you own shares or not, you're getting a W-2. You're having income tax withheld for you. When you're an LLC, you're on the hook for your own taxes. So when you have an LLC, you get, instead of a W-2, you get a K-1 if you're an owner. And on the K-1, there's a box that says guaranteed payments. And what the guaranteed payment number is your salary, or you know, the wages that you took from the LLC on a gross tax basis. So the LLC is not going to withhold your state and local and federal taxes for you. You are doing that yourself. So something to be conscious of when you are an LLC is the fact that you may have to pay estimates based on what you're taking out of the company. Whereas if you had a C Corp, that's how it would all be paid for you. There's a difference between employees and independent contractors. Does anybody know what the difference is? Have you heard that?
Yeah, employees are typically filed with a W-2, and you can dictate where they perform their work and how they perform their work. 1099 contractors basically are independent and not required to be on premises, or you can't dictate how they perform their work. But also, the other main difference is W-2, you're required to do withholding of the payroll, whereas with 1099, they're responsible for their own payroll, similar to like Uber drivers or.
Why are we even here?
I like it.
It's good. Nice. Yeah, so when
I'm
you're
trying to
thinking
something, but.
when you're thinking about independent contractors, it's kind of like, who has control? Are they using your facilities or your tools? Are you telling them where to be, when to be, and that kind of thing? Are they holding themselves out to do the same kind of work they're doing for you for other companies? If they are, they're probably, you know, an independent contractor. Where we see this issue come up a lot is with companies that have interns. A lot of the times, startups, when they're first starting out, you don't have payroll because you probably don't have a lot of employees. And if you're an LLC, you don't need payroll because you get a guaranteed payment. But when you hire an intern, that intern doesn't really know what to do unless you're telling them what to do or teaching them how to do it. So that does trigger a payroll requirement. Now, I think we see it a lot where it's more of a, should you have payroll? Yes. Do you? I don't know. The answer is yes, you should have it to be compliant, but it's kind of a gray area that we see a lot where people just, it's an expense that maybe they don't need to have. But the right answer is yes, you should have payroll because of an intern. Another area where we have a lot of questions is, should you outsource your payroll? 1000%. Payroll is something you don't want to mess up. And if you do mess it up, it can be very difficult to fix it. If you're working with, or trying to work with, say you do it yourself and you mess it up inevitably, and you do try to work with an actual payroll provider, they're going to be hesitant to work with you because they don't want to have to fix the mistakes that you've made in the past and take that liability. So while payroll doesn't seem like it's that complicated, you know, you take a percentage times the wages and that's what you do. There's quarterly filings that have to be done, and depending on, you know, different circumstances, there's different requirements to when you have to submit taxes and things like that. So it's just a lot to get into if you don't know what you're doing. We don't really deal with a lot of payroll. We know enough to be dangerous and we know the broad concepts, but we don't really file payroll on a regular basis. So we typically recommend finding someone that is what they do, and for good reason. That's, you know, they're good at it. When you're hiring people, whether they be independent contractors or actual employees, there are 2 forms that you should get, and you should get these before you ever pay them. An I-9 is for an employee. You probably all filled out an I-9 at some point. It's just kind of your right to work in the United States. You don't really do anything with it. You just keep it on file if you're the employer. But if somebody would ever come and do a payroll audit or something, they're going to say, you know, show us these I-9 forms. Do all these employees have the right to work? The other form is a W-9, which is what you would get from an independent contractor. It has the same information. It's basically their name, address, Social Security number or EIN, and it's their right to work in the United States. You want to get this as soon as you start working with them because it's really hard to get it after you've paid them. So if you hire someone in January of 19 and they work for you, you pay them over $600, and then next January comes and you have to issue them a 1099, they could maybe not even be in the same state anymore. So it's very important to try to get that information as soon as you hire them rather than trying to get it after. And it's a lot easier to get stuff from people when you owe them money and they want the money. So we just always recommend not paying anyone until some kind of system is in place. The worst thing you can do is cut somebody a check because they really want to be paid, and then not have withheld taxes, because then you have to go back and gross up things, and it's a lot. It's a mess. So the best thing you can do is just make sure you have a system in place before you ever pay someone, and that's regardless of if they're independent contractors or employees. And then just, withholdings have to be paid timely. You could have personal responsibility and liability if things don't get paid. So that's another reason why getting a payroll provider to make sure things are getting paid when they're supposed to, especially with due dates all over the place, is a good idea. That way you're not on the hook for anything. So the next slide is just accounting in general. Usually, we don't see a lot of people using bookkeepers when they're just starting out, and we always recommend that if they can and when they can, that's something that you spend money on, because it is so beneficial down the road. You can get away with using Excel when you're first starting out, but it's got to be very clean and very good. If you start out using something like QuickBooks or something like that, it just makes it easier down the road, because what's going to happen is, say you do your own bookkeeping all year, and you kind of know what you're doing, but you kind of don't. So what happens at the end of the year when we get your information? We have to fix things, and I'm not just talking about us, but just accounting firms in general are going to have a much higher billing rate to fix things than like an actual bookkeeper. Sometimes they go off of transactions, or they may spend an hour a month doing bookkeeping, and it might be considerably less than what you're going to pay an accounting firm. So we always recommend just doing it from the beginning and having it all in line. That way at the end of the year, you're not hit with a big surprise when it comes to getting things in order for your tax returns. If you do use Excel, regardless of who your accountant is, it's good to have things grouped, not just all willy-nilly down a list of papers. Have categories for things. If you have meals, or if you have postage or legal fees, those are things you're going to want to categorize. That way they can easily pull things out and know where to put things on a tax return. QuickBooks or other bookkeeping services will have that function already in them. Keep good records of your equity, loans, and documents and things like that. That's something that your accountant is also going to request. And it's much easier to be able to pull those things and give them to them rather than have to go back and ask for copies of things from the banks and things like that. As far as do you need software, one of the major benefits of having accounting software is the ability to pull financials. So I know a lot of you probably at some point will be looking for investors, and those investors are going to want to see financials. So what is nice is, with accounting software, you can go and pull a balance sheet and a P&L at their request. You don't have to say, okay, wait, I need like 2 weeks to take my Excel and put it into some kind of organized format. So the ability to have reports readily available is a very big benefit when it comes to trying to get investment money as well. Oh yeah, if you have inventory, definitely have some kind of bookkeeping. QuickBooks does well with inventory. I know there's other bookkeeping services, but I'm not as familiar. Most of our clients use QuickBooks, yes.
So we're just using QuickBooks for invoicing and things like that. Is it secure? I've always just wondered, because we just put all like our business credit cards and stuff, so QuickBooks just gets automatically updated. Is that like a secure system, or is there?
I mean, as far as I know, I've never seen anything I've never had any issues with it.
None of our clients have ever had any issues, and you would hear about a massive breach associated
that
with
happens.
QuickBooks if that happens. The benefit to doing that, though, is exactly what Megan had said. It'll actually almost pre-categorize your stuff for you if it sees a consistent thread. So QuickBooks, if there's zero, there's other things out there, but I will say be cautious of some of those other platforms that are free because you get what you pay for. Let's just say.
And QuickBooks is a standard for most accountants.
Pretty much all accountants know how to use QuickBooks.
Yes.
Some of the other ones, I think like Xero and ZipBooks, they're set up a little different, so they're not as straightforward, but.
I have a couple clients that use both of those as well. I've seen GoDaddy.
I didn't know they had accountants.
Oh yeah, they did.
I wouldn't recommend.
I wouldn't recommend GoDaddy. But most accountants can pull any of those. And the good part about it is it comes to Excel and it's really easy to manipulate.
Okay.
I will say something that's nice about especially QuickBooks Online is you can grant access to your accountant. So if they need something, they can just go in and pull a report rather than having to bug you and say, hey, can you send me that balance sheet? Okay, can you send it again for this date instead? So that's something that's nice.
Okay.
But, Carissa talking again about early stage issues.
So early stage issues, I'm going to hit the highlights of this. If you guys are registering in Pennsylvania to do business in Pennsylvania, your attorneys will not do that for you. You'll need to fill out a form PA 100, and you'll need to use that as well in order to get your payroll withholding numbers. Do not sign up for payroll until you have payroll. If you sign up for payroll and you don't have like employees yet, you have to file zero balance reports. And no one wants to do that with the state of Pennsylvania, okay, from a compliance standpoint. Also, make sure you have your IRS, your PA, all of your welcome letters if you operate in another state. Make sure to have those on hand, okay? The next thing is convertible debt. Does anyone have any convertible debt yet? Anyone? You do?
No, I don't, but is that, what do you call that? Those like, did you mention the term previously where you give like 4%? Convertible note, is that the same thing?
Yes, a convertible note, any convertible debt, ultimately what it is someone loans you money with the ultimate intent that it converts to equity at some point in the future. So Innovation Works, for example, is a common entity that loans at around 8% interest. I've seen 8% is Pittsburgh's market rate. I've seen 6%. OFEF does. There's a lot of convertible notes. Family and friends will also loan at various interest rates, but the ultimate intent is that it converts to equity. What people don't always realize is those interest rates that I've mentioned are imputed, and you need to be accruing interest on your books every year. So let's say you have a $100,000 loan on January 1, and this is a convertible note, and the interest rate is 8%. That's $8,000 in 2020. So far, so good? If you have a friend and family member, let's say they're an individual who loans you that $100,000, if they're not a savvy investor, what they don't realize is they now have to pick up $8,000 worth of income that they were not expecting. Not only that, the entity is required to issue what's called a 1099 OID to that individual, okay? So it's important, first of all, to keep track of that interest because that'll ultimately convert to equity. And secondly, a 1099 needs to be issued to an individual. If the interest is over $10, which it obviously would be, and if they're a LLC, individual, anyone pretty much besides a C Corp or an S Corp. Not-for-profits also do not need it. Innovation Works is a not-for-profit. CMU is a not-for-profit. They don't care because they don't pay tax, for the most part. So far, so good. Stock options. This is a little premature, but it's something to think about to incentivize your employees. Stock options, there are rules associated with the different types of stock options. There's different tax implications associated with it. Make sure that you're consulting with legal counsel if you are setting up an option plan, okay? Lastly, when does business begin for tax purposes? And you might say, why do I care about this? Well, in my example earlier, let's say you have a $100,000 loss. And in that $100,000 loss was you spending money on the formation of the entity, was you paying the rent of the entity. But most importantly, it was spent on doing R&D. You spend time doing R&D, that is what you're doing. The IRS says that you're not allowed to take certain deductions until you quote unquote begin business. So what I see often done with these returns incorrectly is I see losses passing out to owners or losses being taken on a C corporation that you are not entitled to. Most deductions are not deductible until you begin business. And the definition of beginning business is as easy as when do you have your first sale? Beta sales don't tend to count for this. So be careful. It's a concept that you should talk to with your accountant, and they should be asking that question, because those costs might not be deductible now, but what happens is they get accumulated and until you begin business, and then they get spread out over 15 years. That's the rule. Code section 195 if you're so inclined. Okay, the exception to that rule is research and development. Wages, supplies, independent contractors, if you're paying them to do R&D, that is deductible, but not all of your costs are going to be consumed by that, okay? That's all I have for early stage issues. The next 3 slides are about tax credits. These are the 3 tax credits that you all will be able to take advantage of at some point, and they're the biggest ones from a startup perspective because some of these credits can be sold for cash. It's real money, so please pay attention, as if you weren't paying attention before. So R&D tax credit is a credit that's based off of 3 different categories. Wages for the proportion of time spent doing R&D, independent contractors for the proportion of time spent doing R&D. That tends to be more straightforward because you hire someone just to do R&D. And then supplies consumed in the R&D process. Computers do not count because you're doing things other than R&D with your computers. But if you have chemicals that are being mixed, widgets that go into your medical device component, those types of things do qualify for the credit as supplies. Yes?
What about travel?
No. Travel does not, meals do not. Rent, because you say, all I'm doing right now is R&D, so let me have rent. That does not qualify. Those are the only 3 categories that qualify. Sometimes, in very rare circumstances, patent costs could, but it's very uncommon, and you have an uphill battle to fight when it comes to patents. Okay? The R&D credit for federal income tax purposes is housed on the entity's tax return. If you're an LLC, S Corp, C Corp, it's part of the entity's tax return. There's a special form for it. General rule of thumb is around 6.5% of the costs that qualify give you a federal tax credit. Early stages, you guys aren't making money, so you might say, what do I care about a tax credit because I'm losing money? Those credits don't go away. They simply carry forward until you owe money. But the IRS put a new rule into place because they realized that startups weren't making money, and they now allow you to use the federal R&D tax credit to offset the 6.2% Social Security tax for payroll. The employer's portion of the Social Security tax is allowed to be offset by this R&D credit. And that's real money. That's money that comes in your pocket sooner than you otherwise would have. But it's an election that's made with the tax return, and it's part of the federal R&D credit form. You guys are all spending money doing R&D. You might as well get a credit for it. It's free money. So far, so good? Pennsylvania has a separate R&D credit as well. This credit is a little bit different from the federal because the federal, you can apply for this credit every time. Pennsylvania requires you to have 2 years worth of credits in order to qualify, because Pennsylvania's credit is based off of an increase year over year in R&D expenses. Okay? This is a separate application, and the application is not even released until the summer following the year that you have those 2 expenses. Why do you care about the Pennsylvania credit so much? You can sell this credit for cash. You can get around 80 to 90 cents on the dollar for this credit, because as a startup, you're not making any money. Let's say you have a $100,000 R&D credit, you can get $80,000 to $90,000 in your pocket. You've already spent the money. You're not doing anything different than what you already would be doing, but now you have $80,000 in your pocket to be doing whatever it is that you're going to be doing. Okay, so this is very important. That's all I have from that perspective. The federal credit carries forward, or you can use it against payroll. Pennsylvania can be sold for cash, or it just carries forward 15 years until you use it. Yes.
And isn't there like a certain boundary that they draw for like, it's like you have to be physically located within an area? Or
Nope, that's the next credit we're going to be talking about.
Keystone Innovation.
The KIZ,
Oh,
yes.
yeah, yeah.
So research and development was what we were talking about right now. You guys are all doing research and development. Okay? So that you don't have to be located anywhere, you can be doing anything. The only thing that does not qualify that I have on here is foreign expenses do not qualify. The work needs to be done in the United States. So if you're paying an independent contractor in another country outside of the United States, that does not qualify. Okay? The next credit, to your point, is a credit that's based on an increase year over year. This is the Keystone Innovation Zone credit. But you have to be located inside of a boundary, a zone. There's 2 zones in Pittsburgh, the Pittsburgh Central and the Greater Oakland. Parts of CMU are located in one of the zones. There's a zone across the shore, Alloy 26. There's a bunch of areas where you have to do this. This is a Pennsylvania credit, and you have to be doing something technological in nature, which presumably you all would be doing. And you have to have 2 years worth of revenue. What's interesting that people don't always realize is grant revenue qualifies for this credit. Grant revenue doesn't necessarily need to be contract revenue, it could be grant revenue. This is a Pennsylvania credit where you need to let the coordinator know that you're in the zone, and you need to submit annual and semi-annual reports to them to let them know what your P&L is like. Once you're in the zone, you could be in the zone in December and the whole year qualifies as your base year. You need 2 years worth of being in the zone in order to qualify, 2 years worth of revenue. This Pennsylvania credit can be sold for cash as well, 80 to 90 cents on the dollar. The maximum credit is $100,000, and you can go out and there's a list of people who've gotten the R&D and the KIZ credit in Pennsylvania. Yes?
So what if the company's going to be existing for 2 years, but we didn't make any revenue the first year? You have to wait. It starts in the year that you actually need some
If you're located in the zone, it doesn't change anything, but you have to be in the zone for those 2 years. Your base year needs to have some revenue generation.
Okay.
It can't go from 0.
Okay.
So I've seen some people have like small, minute beta revenue and still qualify. You just need, it just depends. Okay. All right, the last credit is the job creation tax credit. This is a forward-looking credit that you'll take advantage of whenever you have a source of investment money. This is not something you apply for when you've got convertible notes in the early stages. Why? This credit is a Pennsylvania-only credit, and this is a credit that's based off of an increase of jobs inside of Pennsylvania. You need to hire inside of Pennsylvania. Why do I bring it up now if it's not going to matter until later? You need to apply for this credit before you do the hiring. So let's say you get a large influx of cash and you've already hired 5 people or 3 people, it's too late, okay? One of the major things that we talk about with our clients is you can do a whole bunch of little things that add up. All of these little things have planning opportunities, things to pay attention to from a timing perspective, things to pay attention to if you're going to be acquired, if you're looking for investment. All of those little things, all the small things add up to doing it right the first time. So this job creation tax credit, there's information if you guys want to go and look it up, so I'm not going to spend too much more time on it, but let me just say this. These tax credits are free money. The job creation tax credit cannot be sold for cash, it'll just carry forward. But what it is you get a $1,000 credit for every individual you hire inside of Pennsylvania. So it's still free money. You might as well get a credit for what you're already doing. R&D, KIZ tax credits have Pennsylvania credits that can be sold for cash. The federal R&D credit cannot be sold for cash. It'll either carry forward or offset your payroll taxes. Okay? Any other questions in the meantime about credits? Okay. That's actually all I have, believe it or not. The last slide is just a couple thoughts. A couple thoughts from years of experience. I mean, our firm has been working with startups over the years. There's been a lot of things that have come up, things that are facts and circumstance oriented, but like I had mentioned, all of these small little things add up to a lot of tax savings over the years. Early on, you guys don't need audits, you don't need reviews, you need tax help. So making sure that you have your ducks in a row, especially when it comes to compliance, as well as future opportunities with investors and due diligence is probably the most important. But doing it right the first time, you'll sleep better at night, obviously. And secondly, if you don't have those skeletons in your closet, it means a whole lot more as you go to exit. Okay? The very last slide has our contact information. If you guys have any questions, don't hesitate to reach out. I know we're going to stick around a little bit after if you guys have any specific questions that didn't benefit the whole group at large, but thank you all for coming. Thank you for listening to the Cool Kids Do Taxes. And it's something that I enjoy, in case you couldn't notice, but it's fun to talk to you all because you all have an idea. You all have a concept, and you're trying to make your idea work. So it's inspirational. So very well done. Thank you guys for coming.